Inflation is on the rise, but the recent US tariffs are making it even worse. Let's break down how inflation works and why tariffs are driving prices up. Welcome to Nillionaire Investor, where I build wealth the smart way. Let's dive in. First off, what is inflation? Inflation refers to the general increase in prices of goods and services in an economy over time. This means your money loses purchasing power. You can buy less with the same amount of cash. Now, how is inflation measured? It's typically measured using the Consumer Price Index or CPI and the Producer Price Index, known as PPI. There are three major causes of inflation. Cause 1. Demand pull. Too much demand, not enough supply. Cause 2. Cost push, rising production costs like wages, materials, and energy. Cause 3. Monetary inflation. More money in circulation devalues the dollar. So, how does inflation affect us? It erodes purchasing power, meaning your money buys less. It helps debtors repay with cheaper dollars. But it hurts savers and retirees as their cash loses value. Moderate inflation is normal, but high inflation can disrupt the economy. The Federal Reserve tries to keep inflation at around 2% to ensure economic stability using tools like interest rate hikes and open market operations. Now let's discuss US tariffs and their impact on inflation. US tariffs, especially those implemented during the Trump administration, have been a key driver in recent price hikes. Tariffs are taxes on imports, and they raised costs for goods like electronics, steel, and even clothing. Businesses now face higher import costs and pass those costs onto consumers, leading to higher prices on everyday goods. For example, in 2018, President Trump imposed tariffs on $250 billion worth of Chinese imports, targeting industries like electronics, machinery, and consumer goods. By 2019, studies showed these tariffs increased the price of goods by an average of 0.3%, enough to hit the pockets of everyday Americans. A major example is Apple's iPhones, which faced higher production costs due to tariffs, leading to higher retail prices for consumers. Without a trade deal, tariffs might have added about $150 to the base model iPhone 11 Pro, which started at $999. Let's look at the current inflation indicators as of March 2025. The Consumer Price Index, or CPI, shows a year-over-year increase of 2.4% and a monthly change of 0.2%. Key drivers include food at plus 3.0% and energy at minus 3.3%. All items less food and energy are up 2.8%. The Producer Price Index, or PPI, shows a year-over-year increase of 2.7% and a monthly change of minus 0.4%. Key insights include goods at minus 0.9% and services at minus 0.2%. The PPI reflects the prices producers receive for their goods and services, serving as a leading indicator for future consumer inflation. Fed Chair Jerome Powell stated today that U.S. interest rates will remain steady at 4.25% to 4.5% as inflation remains above target, despite strong economic growth. He warned that proposed Trump-era tariffs could reignite inflation and delay rate cuts by up to a year. Powell emphasized that the Fed will stay data-driven and will not rush policy changes. Now, how can you protect your wealth from inflation? Here are a few strategies. Strategy 1. Invest in stocks, as they can outpace inflation in the long run. Consider sectors like energy, consumer staples, and tech, which can pass on rising costs to consumers. Strategy 2. Gold and real assets serve as a hedge against inflation. Commodities like oil and copper also benefit from rising inflation. And a few final tips. Keep cash low, it loses value with inflation. Reinvest dividends for growth. Use tax-advantaged accounts like Roth IRAs to compound wealth over time. Inflation and tariffs are working together to shrink your purchasing power. But by investing smart, you can protect your wealth and stay ahead. Remember, hard work beats talent when talent doesn't work hard. Stay savvy and happy investing. Subscribe for more Nillionaire strategies.